So this video is about bonds. So we're mostly considering corporate bonds. However, I am going to talk about government bonds as well. So I'll be considering the purpose of bonds. I'll be looking at the bond price, its maturity date, its coupon, and the relationship between the price and the yield. So to begin with, what is a corporate bond? So a corporate bond is a type of debt security that is issued by firms within the private sector and it's sold to investors. So the purpose is to acquire capital for business growth. If we consider government bonds, which are obviously different because they're not part of the private sector in terms of issuing them, the reason for government bonds and the reason why the government issues these bonds is to raise capital to fund a deficit and increase government expenditure. So, for example, during this COVID pandemic, the government have accelerated their discretionary fiscal policy to assist with the looming recession. So, to fund this expenditure, it would have required the sale of government bonds. Now, who purchases these government bonds? It could have been the Bank of England via quantitative easing, or it could have been purchased by public investors. Now, back to corporate bonds. So with corporate bonds, the company gets the capital it needs, and in return, the investor is paid a pre-established number of interest payments. Now, bonds are considered to be a long-term source of finance. How long? It completely depends on the contractual agreement of the bond. There has been known in the past of bonds that have been a very, very long term. So, for example, even I think it was Walt Disney once issued a bond of 100 years, but often, obviously, they're not as long as that, but they would be considered to be long term. So when considering what is a bond and the key components of a bond, we must ensure that we know what a maturity date is, what a coupon, and what a yield is. So to begin with, a coupon. A coupon is a guaranteed fixed annual interest payment paid by the issuer of the bond, so the company who issues it, to the owner of it, so the investor who's bought the bond. The maturity date, and that is a date on which the issuer of a dated security pays the face value of the security to the owner. So in other words, the payback date. So when the bond expires or reaches the maturity date, the payment ceases and the original investment is returned. Now a yield, sometimes it gets a little bit confused with a coupon, but they are different. So just a reminder, a bond's coupon rate is the rate of interest it pays annually, and a bond's coupons rate is expressed as a percentage of its par value, while its yield is the rate of return it generates. And I'm going to spend a little bit more time on what a yield is within this video. Now, as I've said before, we will be considering a yield in more depth, and we will be looking at different examples to kind of illustrate the key components I've just mentioned. But to begin with, I want to point out a really, really key part of this topic, and that's the inverse relationship between the price of the bond and the yield of the bond. So remember, the yield refers to the earnings from an investment over a specific period. It includes the investor earnings such as interest and dividends received by holding a particular investment. That particular investment in this case is the bond. So there's an inverse relationship between the market price of the bond and the yield. So if the yield falls, so I'll just point out, if the yield falls, then what we'll find is the market price of the bond will rise. And if, let's say, the market price of the bond falls, then what we'll see is the yield will rise. So there's that inverse relationship, and that's absolutely crucial for this topic. And I'm going to illustrate this via examples. So before I look at the example, I just want to introduce you to the formula, and I will come back to this formula, but the current yield of a bond equals the annual coupon payment divided by the current market price. Now, it's worth remembering that the annual coupon payment, so this bit here, is fixed. So that will not change throughout the agreement of the bond. However, the yield of the bond and the market price can change, hence why there's that inverse relationship, and I'm going to show that via an example now. So imagine we have a firm, let's call them firm A, and they've released a bond, and let's again call the bond bond A. All right. So the price of the bond is £1,000, and they've agreed a coupon of 4%. So therefore, because they've agreed a coupon of 4% over that year, £40 will be paid out because of that 4% of £1,000. Now, as they released this bond, the yield was 4%, and that was the given yield. Okay? Now, let's imagine a new bond is launched in the market after some time, and let's say the interest rate is different now, and actually the yield has increased. And let's say now the yield has gone to 4.5%. Now, what you find is investors would rather buy the yield of 4.5% because of the greater return. So therefore, the demand for Bond A is going to fall. Now, in order to attract others to purchase Bond A, the price and the yield must change in order to generate that demand. And as we said before, remember, the coupon cannot change as it's fixed in the duration of the bond. So if the bond price fell and its yield rose, it would do that. So let's imagine that we're trying to get to reach that yield of 4.5%. Again, that inverse relationship we'll find if we're trying to push up the yield, then obviously the price is going to fall. So what we do, so we have to rearrange the formula that I mentioned before. So remember, the formula was your yield equals your coupon price divided by your market price. But we haven't got our market price now because it's changed the yield. So we do our £40 and we divide that by 4.5%. Remember, it's not 4.5, it's 4.5%. And what we'll get is we'll get this amount. So we'll get £888.89. And again, if you just go back to the original formula of £40 divided by that, it'll be rounded up to 4.5%. So again, what we can see there is we can see that the market price has fallen as the yield has risen, but we're still getting that coupon rate of £40. So again, the simplest way to calculate a bond yield is simply to divide its coupon payment by the face value of the bond. So again, let's imagine this time a new bond has been launched, but this time the interest rate has actually fallen, so the yield's going to fall. So the bond's yield will be low, but Bond A's yield will also have to drop. So as the coupon remains at 4% with a £40 payout annually, the price of Bond A must now rise. So again, if we rearrange the formula, and let's do this now. So our £40 divided by our 3.5% equals £1,142.86. So again, if we use the original formula as I've done here, we'll see that 3.5% equals £40 divided by £1,142.86. So again, as we can see, the yield's fallen, but the market price has risen, but the coupon has remained fixed. Now, from the time bonds are issued until the date that they mature, they trade on the open market, so where pricing and yields continually change, as I've just shown. As a result, yields converge to the point where investors are being paid approximately the same yield for the same level of risk. So what we're going to do now is we're going to look at some multiple choice questions. Now, these are from the AQA specification, however, they are similar to what you might get in Excel. But if we consider the inverse relationship again with interest rates to the yield with the market price, and also consider what quantitative easing is and how it might impact the bond price in terms of demand and supply. So what I want you to do is I want you to attempt this question. Will you pause the video? I'll give you a couple of seconds, and then what I'll do is I'll go through the answer. Okay, so QE, quantitative easing. Just a reminder what it is, it's electronically generating money in order to buy bonds. So because they're buying bonds, demand of bonds is going to rise. And when the demand for bonds rise, also the bond price rises. And that's just a simple law of supply and demand. So the demand for bonds rise, the bond price rises. So again, we can see that it might be A and it might be C, but it's not B and it's not D. Now, if we think about the inverse relationship, if we know that the bond price rises, then the long-term interest rates will fall because of what we've just done there with the previous example. So therefore, it cannot be A, and therefore that leaves only C with the interest rates falling. So the answer is C. Okay, so next multiple choice. If the UK Issued a £100 bond with a coupon of £3 per annum and 40 years until maturity. 2 years later, the interest rate that could be earned on a similar asset has now risen to 6%. What is likely to have happened to the price of the bond and its yield? Again, if you pause the video, have a go, and then I'll quickly go over the answers. All right, so the interest rate's risen. So again, if the yield rises, what happens to the market price? Well, the market price of the bond obviously falls because of that inverse relationship. So what we can see here, the price of the bond will have risen, but the yield will have changed. It can't be that. The price of the bond will have fallen, which we've got there, but the yield will have increased, which we've got there. So the answer is B. Right, this is the final MCQ that we're going to look at, and it's a calculation question, similar to what we've done before in the previous examples. So if the government has issued a bond of £100 and the annual coupon is £6, the bond has 35 years until maturity, its current yield is 5%, the current market price of the bond is what? You need to use that formula, you'll need to rearrange the formula. Again, if you pause the video and have a go, and then I'll go through the answer. Okay, so what you'll get, remember, is the yield equals the coupon over the market price. All right, what we have got is we've got the yield, okay? We know what the coupon is, but we don't know what the market price is. So all we have to simply do is get our coupon of £6, divide it by our 5% yield, and that will get us £120. And again, if you just use the original formula then, 5% equals £6, divide by 120, and it will get you that yield. So the answer is D.